Nobody saw this coming, and yet here we are, Monday morning. Silver opens at $75, and the second that number flashed on screens across trading desks from New York to London to Shanghai, phones started ringing. Because 75 is not just a price, it is a signal. It is the market telling you that something big is being priced in before the full picture is even clear. And if you do not understand what that signal means right now, you could be completely on the wrong side of the most important silver move of this entire year. So let me break this down for you in plain English. No fluff, no hype. Just exactly what happened, exactly why silver is at 75, and exactly what you need to watch this week. Because the next 5 trading days could define silver's trajectory for the rest of 2026. Here is where everything starts. Friday morning, 8:30 a.m., the non-farm payroll report drops. 178,000 new jobs. The street was expecting 60,000, nearly 3 times the estimate. On any normal Friday, that number would have triggered an instant market reaction. Dollar surges, yields spike, silver drops, all of it happening within seconds of the release. But Friday was Good Friday. Every major U.S. exchange was closed. The bond market was closed. The futures market was closed. That 178,000 number dropped into complete silence. No reaction, no pricing, nothing. It just sat there all weekend long, unprocessed, building pressure like steam trapped inside a pipe with nowhere to go. And when Monday opened, that pipe burst, $75 instantly. But here is the thing most people are missing. And this is where it gets really interesting. That 178,000 jobs number is not what it looks like on the surface. Not even close. 76,000 of those jobs, almost half the entire headline, came from a single sector, healthcare. And not because the economy had a sudden healthcare boom, because Kaiser Permanente had a physicians' strike in February. 37,000 doctors were off the payroll. March, the strike ended, they came back, and the government counted them as new jobs added. That is a one-time reversal. That is a statistical ghost. Strip it out, and the real underlying number is closer to 100,000. Now average that with December, January, and February, which were a loss, a gain, and a brutal loss, and the actual 4-month jobs trend is about 47,000 per month. 47,000. That is an economy that is not growing. That is an economy that is barely treading water. And wages, average hourly earnings came in at 3.5% year over year, down from 3.8 the previous month. Wages are cooling. And that cooling, right there, is the most important number in the entire report for silver. Because the Fed has been waiting for wage deceleration as the signal that inflation is genuinely coming down. And it just arrived. Now, if this breakdown is the kind of analysis you want every single week, real data, real mechanics, no noise, hit subscribe right now and hit that like button. Because this channel is built for people who want to understand the silver market, not just watch the price tick up and down. Subscribe now because the rest of this week is going to move fast and you need to be informed. So what does this all mean for silver? Here is the direct connection, and it is critical. Silver is not trading on supply and demand right now, not primarily. It is trading on expectations, Fed policy expectations, dollar direction, yield movement. And the NFP report just created a split narrative that is tearing the market in 2 directions simultaneously. On one side, you have the headline reading 178,000 jobs, way above consensus, economy looks strong, Fed stays aggressive, no rate cuts, dollar holds strong, silver stays under pressure. That is the surface reading. That is what algorithms traded in the first 15 minutes of Sunday evening futures. On the other side, you have the underlying reading 47,000 real monthly jobs trend, wages cooling, February revised down 41,000, and a labor market that has not yet absorbed a single day of tariff impact, because the data was collected on March 12th and the tariffs hit on April 2nd. 21 days later, every company pausing hiring, every manufacturer reassessing their supply chain, every business holding off on growth because of tariff uncertainty. None of it is in this report, not one job. The real economic story of April 2026 does not show up until the May 8th report. And between now and then, things could look very different. That split narrative, strong headline versus weak underlying versus tariff shock incoming, is exactly what creates the kind of volatility that drives explosive moves in silver. Because when 2 powerful macro narratives collide head-on, the market does not move slowly. It moves violently. And silver, which is already sitting right at a major technical and psychological pressure zone, is one of the first assets to feel that violence. Here's the setup technically. $75 is where silver opened. 77 is the first resistance zone, the level where sellers have been active in recent sessions, and where any meaningful rally will face its first real test. 81 is the JP Morgan institutional reference point that multiple major banks have flagged as a fair value target for 2026 based on fundamental supply and demand. And 72.50 is the floor, the level where physical buyers, real industrial users who need silver to build solar panels and EV batteries and semiconductors, have stepped in every single time silver has tested that zone in recent weeks. The key question for this week is which of those levels breaks first? If 77 gives way with conviction and silver holds above it, 80 becomes the next target. And once 80 breaks, you enter what traders call price discovery, where momentum chases momentum. Late buyers pile in, and the move accelerates faster than most people expect. Silver does not move in straight lines. It moves in explosions. And the setup right now has all the ingredients for one. Tight positioning, divided narrative, physical demand floor underneath, institutional fair value well above current price, and a macro catalyst, the eventual end of the Iran war and the resulting Fed pivot that could flip everything overnight. On the downside, if the market decides the jobs headline is hawkish, if the dollar index rallies hard early in the week, if Treasury yields spike on the strong NFP red, then 72.50 gets tested again. And if 72.50 breaks, the next meaningful support is around 68 to 70. That is not a slow drift lower. That is a fast, liquidity-driven flush where leveraged positions get unwound in hours. This is the risk that most retail traders ignore because they are focused on the bullish setup. But the bearish scenario is real, and it needs to be on your radar. Here is what you actually need to watch this week, day by day. On Monday, watch the dollar index in the first 2 hours of trading. If the dollar is surging, silver is under pressure regardless of the geopolitical story. If the dollar stalls or weakens, silver has room to move. On Tuesday and Wednesday, watch for any escalation or de-escalation signal from the Iran war. Trump responded to the F-15 shoot-down over the weekend, and whatever he says or does next sets the tone for oil, and oil sets the tone for inflation expectations, and inflation expectations set the tone for silver. On Thursday, and this is the single most important day of the week after Monday, initial jobless claims drop at 8:30 a.m. Eastern. This is the first real-time labor market signal that starts capturing whether businesses are reacting to the tariff shock. If claims are rising, it is a dovish signal. Dollar weakens, silver gets a boost. If claims are low and stable, the hawkish NFP interpretation holds, and silver stays range-bound. The big picture answer to the question everyone is really asking is this. Silver at 75 is not expensive. It is compressed. 6 years of supply deficits underneath it. COMEX inventories down 70% from their 2020 peak. China's export controls locking up 60% of globally traded refined silver. Industrial demand from solar, EVs, AI, and nuclear power growing structurally. Wages finally cooling the way the Fed needs. The gold to silver ratio sitting above 60, which historically means silver outperforms gold over the next 12 to 24 months. Every single structural argument points the same direction. The only thing holding silver at 75 instead of 90 or 100 is the temporary macro headwind. Oil above 100, strong dollar, delayed rate cuts, all of which are attached to the Iran war. When that war ends, and it will end, those headwinds disappear simultaneously. And what is left is a structurally undersupplied market with exploding industrial demand and a Fed that is about to start cutting into a weakening labor market. That combination does not produce $75 silver for very long. Silver at 75 is the setup. The confirmation is what this week delivers. And whether this Monday open becomes the launch pad for the next major move or the beginning of one more shakeout before the real breakout, you will know the answer by Friday. Drop a comment right now and tell me, do you think silver breaks above 77 this week, or does it get pushed back to 72? I read every comment, and this week I genuinely want to know what you are seeing. And if this breakdown was useful to you, share it with one person who follows silver or precious metals. It takes 5 seconds, and it helps this channel reach more people who deserve real analysis. Subscribe if you have not already. Hit the bell. Because the next update is coming fast. This is the most important open silver has had in weeks. Pay attention.